G'day there. Welcome to the Closing Bell, which I'm recording on the 4th of August. Today, I'm going to do a bit of a bird's eye view of the market, really go out look at 50 years of trading to get a sense of how our market moves, what happens over time. I want to really give you a bit of a deeper understanding of why I'm thinking we're getting closer to the end of this bad period. And regardless of what happens in the short term, I can still think there can be some selling pressure coming, but it's sort of heading to a period where, if you look back in history, it's a time to be thinking about accumulation rather than dumping stocks with everyone else. If we do see, let's say, another leg down the next few months or whatever. So I want to really give you that sense of how our market moves, and give you a bit of an understanding of why I'm currently running this presentation. Now, look, I'm going to show you a link in this video. I'd really love you to check out that presentation where I really do a bit of a deep dive on what I do at Retirement Trader, how I help people and have done over time, over the last 4 or 5 years working here in this role. But really, for you to get a sense of the company that I work for, I mean, look, I know I'm sitting here in this room. It's my home office. I love working from home. But, don't get the wrong impression. This is, I'm part of a company of 50 people. We've been around for decades, really helping people build their wealth. Not really mainstream. I'm not part of a broking shop. I don't have any sort of conflict of interest in what we do. We're just here trying to help people out, showing them different ideas. And I've been doing that with the Closing Bell. Hopefully you've been watching and following along and getting a bit of a sense of what I look for. Gave you Megaport recently, Nuix just a few weeks ago, which took off like a rocket, up 50% in a week. And look, I'm not going to be just throwing out free trading tips for you. I've got to keep them for my clients. I've just been doing a few recently to give you a sense. But most of the time, I'm going to just look at the world markets and give you a sense of the macro picture rather than giving you actual stock tips. Because really, why should you get stocks that go up 50% in a week for free? That would be a pretty silly way to run my business. Let's just jump to the charts, the really big picture charts. I think it's going to be eye-opening for you how things move. But yeah, please click on the link that'll show up in the video and check out my presentation. Would love you to do it if you've got any sort of interest in what I'm up to and you're trying to build wealth over time, looking for ideas. And I'd love to work with you doing that. So let's jump to the charts. So this is the ASX 200 over a very long period of time. And I'm using a log scale here, because when you look at really long-term charts, it makes far more sense to use this type of scale. And what that scale means is that the distance on the chart will be the same percentage change in the price. So that the same distance will be the same percentage change, whereas on a nominal chart, as you know, it's not like that at all, is it? As it goes up, the move down here will be a much bigger percentage change than a move higher on the chart because of the nominal changes in numbers. So that's all that does, is it makes sense of the long-term data. And that's really what you need to do if you're looking at many decades of trading data. Now, I just want you to notice, I've got the channel in there that I'm showing you. This is the ASX. We've got the rally into the 87 crash. You can see there. And I just want you to note that really long-term channel of prices. This is where you can see and sense the fact that markets do go up, regardless of whether you've got, periods with crashes and long periods of selling off and what have you, which happens, on a regular basis. We've got the crash there and the selling that occurred. But really, over time, markets end up gravitating higher. We've got inflation, we've got growth happening over time. So you can't lose sight of that fact, that regardless of what we're thinking right now, short term, this is the path that you should expect. And what I want you to note also is, the weakness that we see. So let's say we've got these major peaks which occur, and we have, periods of weakness after it. I'm just looking at some of the major peaks that we've seen over time and looking at how long it takes. How long do these bearish periods take? Really, you've got to get a sense of how long they take, because you can see that they end up being pretty similar. The length of time that it takes a market to correct and then get ready to take off. And that's one of the big things I'm covering in that Window 24 presentation, is giving you a sense of history and of how markets really move over time, how they react after these major peaks, when we go into a correction or crash or whatever. How do markets then evolve after those peaks, and when is a good time to be picking stocks up? And another thing to note is, when we do have these big sell-offs, when is the best returns? When are you going to get the best returns? Well, pretty clearly, when you're buying near the bottom of this channel, isn't it? And now the market may not look very good at that period. It's after these crashes. This is getting pretty close. Here's the 2020 crash, going right down to the bottom of that channel. Would have been great buying if you're looking at it from this very long-term perspective. And so going forward, having that same idea over time, that if this market's going to evolve as it has for decades, really, even if we do see, let's say, a short-term sell-off, and this is 2 years data just here, even if we do see a bit of a clear out over the next few months, what do you think you should be doing in that time? Do you think it's time to be getting out, or time to be buying based on this long-term chart? So clearly, weakness from here is going to be an opportunity based on this very long-term channel. That's one of the major things I want to get across, because we do always look at these very short-term moves and don't think about the big picture. Another thing to note is, after that 2008 crash, the market can take time after a big crash to just get ready to move higher and break out. And after the 87 crash, look, it was 10 years before the market was ready to break out above that range. It had a few tests, didn't it? Early on, went to retest, sold off again. Went to retest, sold off again, broke out, retested the breakout, and then look what happened once it really broke out above that crash, pre-crash high. So thinking about it in terms of where we're at now, there was that 07 high. Look at where we're at. It's been a hell of a long time, hasn't it? Since 07, now we're talking 15 years since that peak. So from that point of view, we're currently in a similar position to what you saw here, aren't we? It's been years of terrible market. It's rallied, and then we have a couple of years of trying to bust out above the former high, right? So there's that high. There's lots of work done, and then it's ready to take off. So where are we now? We've had the retest and then the rejection, which was at 2020. We've rallied back. So we're in this period now, aren't we? A few years trading, flirting around this old major high, but ultimately it will bust out. And that's when you can often get a really good move higher, because it's been so long since that peak. Market values have caught up and it's ready to have its next move higher, which can be many years. That's sort of the period we're entering. And if you, again, looking at this channel, you know, if you're buying above that midpoint, so that dashed line being the midpoint of the channel, now if you're buying up here above that midpoint, well, you've got years of waiting around, haven't you, before it really takes off. Again, buying above the midpoint, couple of years of selling, buying above the midpoint, few years, buying above the midpoint, sell off. And again, in the last few years, buying above the midpoint, here we are getting below the midpoint. So if you're buying above that long-term trend, you know, you can end up still doing well, of course, over time, but your returns early on aren't that great. But if you're buying below the midpoint, periods when prices have had weakness, so the chart looks bad at these times. You remember that, how you'd be looking at the charts at the time when they are below the midpoint. And look at what happened if you were a buyer in those periods. Now that is a much better outcome, isn't it, than buying above the midpoint when things are looking a bit stretched. And here we are. Now we can start zooming in, going from that bird's eye view and thinking about what's going on and the fact that it's just starting to head below, isn't it? We've had one wave below, but it's still below. And look, we're at this point where either prices break out above that all-time high from the last couple of years, and it's then away, and who knows what can happen above there. That means my model would be switching positive, long-term trends up, breaking out above the all-time high. I will be aggressive if that happens soon. And this is that, I'll get into that window 24 with you. But also, at the moment, it is, as I'll show you in a minute, still below the all-time high and still in an area where we could see a bit of short-term weakness. And what I'd love is if we saw one more wave down. And tell you what, I'll be just very aggressive once I get the signals if we see that in the short term. That is still a potential outcome. Aware of that, being aware of that. But in the very big picture, it's still this area and this time, regardless of what you think is going to happen in the short term, just this window is a time when you should be thinking about accumulating for the very long term rather than dumping if we do get a bit of short-term weakness just in the next few months or whatever. So we're thinking really big picture at the moment, looking at that really long term, which you rarely think about and look at. But in the context of the price action that we've seen for the last few years, just thinking about that fact that it's been 15 years since that market peak, and looking back, it was 10 years before it finally broke out above the 87. It's a very similar sort of situation And the window 24 being, it's been 2 years since the market peak. And I'll go into this in nice detail in the presentation, which I'd love you to check out. So if I look just at the last few years trading, and we think about this range, it's been going nowhere for a couple of years. Let's look back at, past peaks and think about what was happening a couple of years after that peak. Was it a time to be selling or buying? So if we're looking here, that was not a bad spot to be buying, was it? So if I go back further, I look at these peaks and I say, well, what was happening 2 years after that peak was about there. That was a pretty good time to be buying, wasn't it? If I go further back, we just look at some of these, even there, that was a tough one because it had a really sharp crash and recovery. So 2 years on was probably around here, around 2010, and the market went sideways for a few years after that. But 2001, you can see that the market can go sideways for a few years and look terrible. But often after the peak, if you're looking a few years forward, it's actually a time to be accumulating stocks, not a time to be running scared. So another peak there. There's about the same 2 years afterwards, was getting ready to break out for a multi-year rally. But really that's the sense that I want you to get, is you got these major peaks, the big drawdowns, recession, whatever. Market looks terrible on the charts, but if you look thinking about what happens 2 years after the peak, it was actually a pretty good time to be getting involved. And that really is something that I'm going to go in with you deeply in the presentation, give you a sense of looking at these major peaks, how prices have developed in the past. And then really that's all we can use is thinking, right, well, what's happened in the past? What are the odds that the market's going to either rally or continue selling off at the moment? So there's a lot that I've shown you there. It really is just getting a sense that the lower this thing goes now, the more it's heading towards the bottom of that channel, which quite clearly has been a pretty good time to be accumulating stocks, not a time for running away. So looking at the markets in the shorter term, this is the US 10-year bond yield. Just wanted to quickly show you this because we are seeing an uplift in the yield at the moment. So I just wanted to show you this long-term chart, again, going back decades. There's your massive rally in risk assets, isn't it? And we've seen what looks like it could be a bit of a change of trend, isn't it, in the big picture? And really that long-term uptrend in yields, and this is a chart of yields, so yields rising, bond prices going down, it doesn't look like it's really over yet, does it? The huge supply coming of bonds out of the US. Market was a bit surprised this week by the amount that Treasury are going to issue, and rates at the longer end starting to kick higher again. So just in the short term, this can be a bit of a headwind for stocks. Just notice that, long-term trend shift, 10-month exponential above the 20-month simple. And you can see over time, it's been a pretty good indicator of what those bonds are doing. Multiple years, these moves in yields, you can see there. So really this long-term uptrend, nothing saying that is over, the long-term uptrend in yields. And if it busts out above that high, maybe yields go for another run, I think, which would surprise quite a few people. So just be aware that the 10 years or the whole yield curve is steepening in the US at the moment, and that can just cause some problems, headwinds for those long duration stocks like tech stocks, etc. So it might just mean we're in for a bit of short-term weakness, which I was warning you about last week. Let's have a look at the S&P. So this is the S&P on the monthly last week. I was saying that the rally was all looking good, weekly trend all up, but the one final hurdle before this market turns 100% bullish is the fact that prices are in the sell zone of that correction over the last year. All right, so here's your 2020 crash. There's that massive wave higher. You should know the correction went right back to the midpoint of that wave. And now this rally, which I think has surprised many people, causing lots of short covering, has made its way up into the sell zone of that whole correction. That's the area where I said, look, some selling can actually come out of the woodwork here and surprise people a bit. I said that last week. And that was when the market was, on its highs up here, no sign of any selling pressure, all looking fabulous. I'm saying, look, it's getting up to the top of that sell zone. And often around here is a point when you're starting to think, well, just watch out. And if we get the confirmation of the weekly sell pivot, so that's a weekly close below the low of that highest price candle, that's the first sign. We look at the sell pivots in the past on the weekly. They have been a pretty good indicator that momentum was turning back down. Weekly sell pivot. And we haven't had a weekly sell pivot since the weekly buy pivot all the way back here. And then it all, turned into weekly uptrend, and it's just been continuing, broke out above those key levels. I said above there, watch out, it can rally. But if you look back in the past, I did actually say it could, rally up into this sell zone and then sell off. And this is just the very early signs of saying, well, we could be in for just a bit of weakness. And look, that's not to say that it's not going to, head back to support and then keep going, maybe even all the way back to the point of control and turn around and rally. But just noting that with bond yields doing what they're doing, a weekly sell pivot in the S&P 500 within the sell zone of the whole correction is the spot that my model says just tread a little carefully for the moment until you get that weekly buy pivot again. And really, that's the very first step in weakness. So, it's not a call saying that the market's about to fall over at all, just that the short-term trend is possibly going to be a bit weaker than it has been. But bigger picture, really, it's not until, and I think I need to go longer term to prove my point, it's not until we get that weekly trend turning down that we need to worry too much. So just showing you, very long term, it's 2013. Look at that weekly uptrend, weekly downtrend starts there, big sell-off. Weekly downtrend there, big sell-off, but then uptrend carries on for years. Weekly downtrend there, it's a bit of a sell-off, but not much. Goes back into weekly uptrend, weekly downtrend there, huge sell-off. Weekly uptrend goes on for a long time. Weekly downtrend, there's your 2020 crash. Weekly uptrend goes on for a very long time. Weekly downtrend, there's the big correction. And so currently it's in that weekly uptrend, isn't it? And a very strong one. So until the weekly trend turns down, if you can see here, that is all still in weekly uptrend. This selling pressure, that's just a very first step, right? So that's all that's saying. It's not saying it's going to do this, just saying that it's not time to buy. And we really need to see that trend shift before we can move to that next level of saying, well, this might have a bigger leg to the downside. But the fact that it is in the sell zone of that whole correction is just where your ears are pricked up, saying this is where the bigger sellers can come out of the woodwork. And, how far down it goes, again, you don't know. But you're just saying be wary, just dead ahead. All right, well, I hope that makes sense. Looking at that really big picture over 50 years, we're in a period 2 years after the correction where you're starting to think constructively about picking up stocks, but just short-term signs are of a bit of weakness ahead, which is going to be, ultimately a great opportunity to get long. All right, cheers. We'll come back with more next week. And please do check out the presentation. That goes offline next Tuesday. So check it out before then. All right, cheers.